Welcome back, deep divers. If you joined us for part 1, you already know we journeyed into Power Grid Infrastructure Investment Trust, or PGInvIT, understanding its strong foundations and vital role in India's energy grid.
That's right.
Today, though, we're shifting gears completely.
We are. This deep dive is really all about PGInvIT's future. We're going to explore their strategic moves for expansion, how they're looking at India's rapidly changing energy landscape, and the hurdles they're preparing to navigate. Think of it as mapping their road ahead.
Charting a course for sustained growth.
Exactly, in a pretty dynamic sector.
Right. From ambitious acquisition plans to, managing risks in a market that's always evolving, we'll unpack what keeps this infrastructure giant ticking.
And what that means for you.
And what that means for you, whether you're just a curious observer or someone thinking about future investments.
Yeah.
It's a fascinating story of strategic foresight meeting real-world challenges.
It really is.
So let's get into it.
Let's do it.
All right.
Expansion and acquisition strategy, powering future growth.
Okay, let's start with their blueprint for growth. What's PGInvIT's explicit game plan for scaling up, especially when it comes to bringing new assets into their portfolio?
Well, their strategy is actually quite clear. They're actively scouting opportunities to acquire operational transmission assets.
Operational ones specifically.
Operational, yes. This isn't just about, grabbing any new project. It's a savvy move to consolidate and expand their core business.
Okay.
And a really significant recent step was back in December 2024. They acquired the remaining 26% equity in 4 of their special purpose vehicles, SPVs, basically.
Right, separate project companies.
Exactly. KTL, PTTL, WTL, and JPTL from their sponsor, Power Grid.
Okay, and that cost?
That move alone cost over 5 billion Indian rupees, so roughly $60 million US dollars.
Wow.
And it was mostly debt funded, but at competitive rates. The whole aim there was really to deepen their ownership,
Right.
Enhance returns, give them more direct control over these existing revenue-generating assets.
So it sounds like they're solidifying their current base while also looking outwards.
Precisely.
What's the real talk then when it comes to acquiring transmission assets from state governments? Is it still just policy discussions or are things actually, moving on the ground?
Oh, it's definitely moving beyond just conceptual discussions. They are actively engaging and exploring these opportunities.
Okay.
A great example of this intent was a workshop they held in December 2024. PGInvIT co-organized it with the Central Electricity Authority, the CEA.
Main technical body, yeah.
Right, and other key financial institutions. And this workshop specifically focused on the monetization of transmission assets.
Interesting.
And crucially, it had senior officials from several states attending. That signals serious interest and a collaborative environment for these deals to actually happen.
That is a strong indicator of progress.
Yeah.
So what about acquiring assets from other private players? Is there a policy framework supporting that? And are they actively pursuing those kinds of deals too?
Yeah, they are. PGInvIT is absolutely actively exploring opportunities with private transmission service providers.
Okay.
Now, while there isn't a brand new specific CEA policy just for this purpose that's mentioned,
right,
the broader environment is described as very supportive. There are existing government guidelines on monetizing transmission assets by states, and those inherently open the door for private-to-private transactions as well. It's all part of a larger push to bring private capital into infra development.
Makes sense. So given all this potential, what's the expected timeline for these under-construction private projects? When could they become operational and actually enter PGInvIT's radar for potential acquisition?
Well, the National Electricity Plan, it envisions massive transmission capacity additions right up to 2032. Huge numbers.
Okay.
Now, while the market currently presents, let's say, limited acquisition opportunities for assets that are already operational.
Right, the ready-to-go ones.
Exactly. PGInvIT anticipates this landscape will become increasingly favorable. Why? Because a larger pipeline of those operational transmission assets should become available in the coming years.
Ah, okay, so they wait for them to be up and running.
Precisely. You see, InvITs like PGInvIT are designed to hold operational revenue-generating assets, not really projects under construction, so they're waiting for these projects to mature.
Got it.
And just as an example of internal development, within their existing portfolio, one of their SPVs, PPTL, has a 400 kV line bay project that's scheduled for completion by the end of 2025.
Okay, so that clarifies their focus on operational assets. Speaking of their sponsor, Power Grid, are they expected to divest any more assets to PGInvIT this year, or have that particular chapter largely wrapped up for now?
That's a good question. Based on the recent acquisition of that remaining 26% equity in the 4 SPVs, which means PGInvIT now hold 100% equity in their initial 5 core assets. And the fact that the information available also indicates no divestment of assets has been made during the year ended on March 31st, 2025.
Okay.
It really does suggest that the main phase of divestment from their direct sponsor is, well, largely complete.
So the focus shifts outwards.
Exactly. Their future acquisition efforts are now pretty firmly centered on those external opportunities, state governments, and other private entities. It's definitely a shift from internal consolidation to external growth. 2, future outlook, beyond traditional transmission.
Okay, here's where it gets really insightful, I think. India's energy landscape is rapidly shifting towards renewables. We all see that.
Absolutely.
So is PGInvIT looking to diversify into new areas, like renewables themselves, or perhaps battery storage systems, or are they sticking strictly to their needing, transmission?
Right. Well, PGInvIT's strategic alignment with India's energy transition is focused squarely on providing the transmission infrastructure needed for that shift.
Okay, so the pipes, not the power source.
Exactly. Think of them as building the energy superhighways for all that green power, with renewables already over 220 gigawatts.
Huge numbers.
And a projected 13.5 gigawatts of battery storage capacity coming online by 2027. The demand for robust transmission to connect these diverse sources to the grid is just immense.
Makes sense.
And PGInvIT's existing interstate transmission system, the ISTS assets, they're already described as clean energy compatible and revenue secure. Meaning they facilitate the integration of renewables by ensuring the power actually gets where it needs to go. So yeah, their core focus remains firmly on transmission.
And acquisitions reflect that.
Yes, with a very disciplined and independently valued approach to all acquisitions. They're not looking to generate power, just to move it efficiently and reliably.
That's a crucial distinction for investors to understand. Yeah. Let's talk returns. What's the outlook for distribution per unit, or DPU? Basically, what investors get paid out for the upcoming fiscal years, say FY 2025, 26, and beyond, especially if new acquisitions don't materialize as quickly as hoped.
Yeah, that's always the key question, isn't it? While a specific DPU forecast for future fiscal years isn't provided in the material,
Right.
PGInvIT did declare a DPU of 12 per unit for FY 2024-25. And importantly, that aligned exactly with their annual guidance.
Consistency is good.
Very. And what's really significant is their track record. Since their listing, they've consistently created value. Cumulative distributions are 46.50 per unit against an IPO price of 100.
Not bad at all.
Right. And their policy actually mandates distributing at least 90% of their net distributable cash flows. They've consistently exceeded that threshold.
So even without rapid acquisitions.
Well, the consistency of future DPU, particularly if new assets aren't acquired quickly, will rely heavily on maintaining that incredibly high operational availability.
Which I've done.
Consistently over 98%. Plus efficient management of their robust existing asset base. That's their bedrock, really.
Right. Okay, interest rates. Big topic globally.
Yeah.
If they fall further, how does that actually impact PGInvIT's cost of funds? And what kind of uplift in returns could investors realistically expect? Is their debt portfolio large enough for this to really, move the needle on DPU?
Oh, it absolutely could move the needle, yes. PGInvIT's long-term debt obligations mainly carry floating interest rates.
So they benefit if rates fall.
Correct. As of March 31st, 2025, their consolidated long-term debt stood at over $10.7 billion.
Okay.
And the company actually quantifies this impact. They report that a mere 50 basis point change, that's just 0.5% in interest rates, could impact their profit or loss before tax by approximately $35.02 million.
Which is noticeable compared to their cash flow.
Exactly. It's a noticeable figure when you compare it to their FY 2024-25 net distributable cash flow, which was over $10.8 billion. So yes, falling interest rates would indeed positively influence DPU.
And their credit rating helps here.
Definitely. Their AAA credit rating and very low net debt to AUM, only 5.52% as of March 31st, 2025, that enhances their ability to secure low-cost capital and manage financial risks, makes them quite resilient.
Okay. Given their commitment to consistent distributions, are they exploring ways to make these payouts even more tax efficient for unit holders? Maybe through, new structuring mechanisms or something?
Well, the company provides a very detailed breakdown of its DPU components for FY 2024-25. It shows, what was taxable dividend, exempt dividend, interest, repayment of SPV debt, treasury income, reflecting the current tax treatment.
Standard stuff.
Pretty standard, yes. And their governance strictly adheres to PGInvIT regulations. That's the market regulator's rulebook for these trusts. It ensures investor protection, transparency.
But no fancy restructuring mentioned.
Exactly. The available information doesn't specify any proactive steps or new structuring, like, for instance, NCLT structuring, which sometimes involves using the National Company Law Tribunal for corporate restructuring, occasionally for tax optimization.
Yeah.
None of that is mentioned as being pursued to make distributions more tax efficient beyond their current compliant framework. They seem to operate squarely within the established rules. 3. Anticipating and mitigating future hurdles. Navigating the landscape.
All right, let's talk hurdles. Every major infrastructure player faces headwinds. What are the key operational risks PGInvIT sees on the horizon? Things like grid stability or maybe managing older infrastructure over time.
Sure. They've identified several operational risks. A primary one is, unsurprisingly, the financial health of their customers. Delays in payment of transmission charges, for example.
Could hurt cash flow.
Could certainly impact cash flows, yeah.
Right.
Then there's the ongoing challenge of just maintaining their impressive target availability.
That 98% plus figure.
Exactly. It's consistently exceeded 98%, but any failure there would directly affect their revenue. It's critical.
Understandable. What else?
They also note the risk of increased operating and maintenance O&M costs, because their transmission charges are largely fixed. Unexpectedly higher O&M costs could potentially squeeze profitability.
Okay.
And finally, grid disturbance risk, unplanned outages or instability. That's a recognized concern that could disrupt their operations.
So how do they mitigate these?
Well, they emphasize their use of modern O&M practices and technologies. Things like drone patrolling for early detection of potential issues on the lines, and AML-based analytics to try and predict and prevent problems before they happen. Proactive maintenance, essentially.
Okay, that makes sense.
Yeah.
What about the regulatory landscape? Are there regulatory changes that could pose a risk to their growth or profitability? Maybe from CERC or the broader NVIT regulations themselves?
That's interesting. While the company doesn't list specific regulatory risks in the same direct category as, say, operational or financial ones, they strongly emphasize that their availability-linked revenue model and their long-term contracts inherently offer minimal regulatory risks.
Do they feel pretty insulated?
That seems to be their current perception, yes. A stable and supportive regulatory environment from bodies like CERC, which regulates power, and SEBI, which regulates NVITs.
But things can change.
Of course. The dynamic nature of regulations means continuous monitoring is always essential, even if they currently feel well protected by their structure.
Right. Okay, beyond the operational and regulatory side, what about financial risks? Especially those linked to interest rates, which we touched on, or maybe refinancing their substantial debt down the line. How are they planning to manage these over the long term?
Okay, on the financial front, credit risk they consider quite low, primarily because most of their transactions are actually with their own subsidiaries.
Internal flows mostly.
Largely. Liquidity risk, meaning having enough cash on hand to meet obligations that's managed through robust cash management systems, and frankly, by generating plenty of cash flow from their existing well-performing operations.
And interest rate risk.
Right. As we discussed, their long-term debt has floating rates. That does expose them to market fluctuations.
So the management strategy.
To manage this and other financial aspects, they maintain a deliberately low leverage structure. They're always aiming for an optimum gearing ratio. And they truly benefit from that AAA credit rating.
Which gives them options.
Exactly. It ensures they can always access competitive funding, even in volatile markets. It's a key strength.
So let's talk big picture hurdles to their growth. You mentioned limited acquisition opportunities earlier. Is that the main one? And what are their proactive strategies to keep those revenue streams flowing and growing?
Yes. The most significant identified hurdle to growth is indeed the limited availability of acquisition opportunities, coupled with a highly competitive environment in the power transmission sector in India. It's a hot space.
So how do they overcome that?
Well, proactively, PGInvIT is actively pursuing new opportunities by engaging with both state governments and those private transmission service providers we talked about, specifically for asset monetization deals.
Leveraging their strengths.
Absolutely. They're leveraging their strong credit profile, the trust of institutional investors that they've built, and crucially, their access to low-cost capital. That positions them at the forefront for these new opportunities.
Makes sense.
Their core strategy here is really to strategically target assets and optimize its portfolio to maximize unitholder value. And this aligns perfectly with that massive 9.16 lakh crore, about $110 billion USD investment planned in India's transmission sector up to 2032.
So while competition exists, the pie is also growing significantly.
That's a very good way to put it, yes.
Okay, given all this, how does PGInvIT's valuation actually stack up, say, against its underlying assets or maybe other investment avenues? And what's management's perspective on any potential market discount?
Right, the numbers. As of March 31st, 2025, PGInvIT's fair value net asset value, the NAV per unit, was calculated at 94.12.
Okay, that's the theoretical value.
That's the value based on their assets, yes. In comparison, their market capitalization on the same day implied a per unit price of approximately 75.99.
So quite a discount there.
Yes, the market price was trading at a noticeable discount to their underlying asset value at that point. Now, management asserts that their present valuation and NAV reflect the strength of our underlying fundamentals.
But they don't explain the discount.
The available information doesn't explicitly offer management-specific perspective on why there might be that market discount to NAV or provide a direct comparison to other similar investment avenues in the broader market.
So that's something for investors to weigh up.
It is. It's a key point for investors to consider that gap between perceived market value and the calculated intrinsic value.
So ultimately, boiling it all down, does the company continue to align with the long-term goals of someone looking for, say, stable income, maybe some capital appreciation, and solid infrastructure exposure?
I would say absolutely yes. PGInvIT consistently positions itself as a reliable infrastructure investment platform. This is underpinned by what they call their AAA framework. Remember that. Robust assets, assured revenues from long-term contracts, and predictable cash flows with low leverage.
Right, the 3 A's.
Exactly. And that framework truly reinforces their commitment to consistent value creation and, crucially for income investors, uninterrupted distributions.
And the infrastructure exposure.
Well, their strategic alignment with India's expanding power sector and that massive energy transition inherently provides significant core infrastructure exposure for long-term investors looking for stability within a real growth story. Outro.
Wow. What a deep dive into the future trajectory of PGInvIT. We've really seen how they're building on an already strong foundation, actively seeking new avenues for growth through these strategic acquisitions.
Really targeting those operational assets.
Right, and diligently managing the inherent risks that, let's face it, always come with operating vital infrastructure, their commitment to reliable returns, and their clear alignment with India's energy future that really stands out.
It does. And this leads us to a fascinating question, I think. As India pushes so rapidly towards its ambitious 2032 power targets, and we see this increasing integration of renewables, how will these massive planned transmission investments actually reshape the very definition of infrastructure stability for entities like PGInvIT? And maybe more importantly for listeners, what new, perhaps unexpected opportunities might emerge for investors seeking both that consistent income and impactful exposure to an economy undergoing such a profound transformation.
That of a powerful thought to consider indeed, something for all of you to mull over. Thank you for joining us for the second part of our deep dive into PGInvIT. Stay curious, keep exploring.
Keep digging deeper.
And we'll see you next time on The Deep Dive.